the markets are fucked. And when I say the markets, I mean kind of the world. There's lots that we can do to put ourselves on the right side of this downturn, but there is going to be a downturn. I have about 20 charts here that are all screaming that this house of cards is about to fold in on itself. This is extremely important. I'm not just saying that because I'm making a video on it. Really, I'm smiling and laughing now, but this is fucked. This is really fucked. As I said, there's lots we can do to put ourselves on the right side of this downturn, which I will get into. But I think this is really is worth a watch. I think you should pay attention and seriously deep how fucked this can be if we don't take action now and put ourselves on the right side of this downturn. All right, going to get straight into it. This is full crazy scientist mode. Going to try and simplify it as much as possible. Let's get stuck in. Okay, so you can see what I mean by crazy scientist mode. I need to get all this stuff up on the wall. This is the part that I want to cover today. So, looking at the economy and the metrics / red flags that we need to be monitoring that are signals for us that we're, one, going into a recession, and two, that everything's just going to fucking collapse. So, first thing we look at is the consumer health. So consumers play a massive role in the economy. How healthy are they? How much debt do they have? How much are they spending, etc.? So we can see now that the average American now carries $6,329 worth of debt. So this is kind of crazy. Look at this. Since 2021, credit card balances have skyrocketed upwards of 48%. So that's almost a 50% increase since 2021. We now have $1.14 trillion worth of credit card debt in the US. I don't know why I'm saying we. Credit card debt is at all-time highs right now. So this alone isn't alarming. What's alarming is when we start getting delinquency rates rising. So delinquency rates is basically people failing to pay back their loans. So look at these. This is fucked. So delinquency card holders rising. These charts here are the rate of delinquency rates. So the rate of people failing to pay back their debts. So on the credit cards, look, we can see here it bottomed out at around mid 2021. So that's when they were doing all the printing. So they were just giving out money, just creating currency out of thin air, just giving it out. Everyone started going crazy, borrowing loads, and now we can see creeping up and up. Delinquency rates, all-time highs, the same. So this one was for credit cards. This is for consumer loans. So we can see they're failing as well, and business loans as well, all failing. So this is housing, so people failing to pay back their mortgages. So we can see no matter what chart we look at, more and more people by the day are struggling to pay back all the money that they've borrowed. So this is happening on a massive scale. So every day more and more people are failing. This is putting more and more stress on the institutions, on the banks. So imagine millions and millions of people failing to be able to pay back their debts. We know that the banks only hold a fraction of their currency in reserves, hence the name fractional reserve banking. So what happens when more and more people fail to pay back, more and more stress? One of two things happen. We either get a repeat of Lehman Brothers 2008, where they end up actually liquidating, or the government steps in. If the government steps in, that means they're creating more money out of thin air. So they either let the bank fail, which then means everybody who has their money invested in that bank loses that. So people lose their pensions, people lose their life savings, everything. Or what the government can do is step in, create Treasury Bonds, basically generating currency out of thin air to cover the bank's losses. So the people keep their savings, they get covered. However, with that, they're introducing a shitload more of currency into circulation, which means that it's just kicking the can down the road. Every single dollar then becomes less valued, which means they need to print more. So this is actually benefiting them. They're going to write off some of their debt every time they print currency. What it's going to do for us is it means that every dollar that we work for, dollar's the world reserve currency, I'm just using dollar as an example, whatever the dollar does, everything else kind of follows suit. It's over 60% of the currency in the world is held in dollar. So either situation, it's a lose-lose. I do see that there could be this interest rate slash to, as we can see here, to 0%, like they did when the pandemic hit. Slash interest rates, boost the economy, but just kicking the can down the line. And now those interest rates slash is what's coming back to bite us now. So when they slashed those rates back in 2020, after that proceeded 11 rate hikes. So then they increased rates 11 times after that to make up for it. But it's just the pendulum swinging back and forth. It's the damage is already done. As soon as the bonds are created, the damage is already done. The recession is already guaranteed after those bonds are created. The Treasury writes the bonds, sells them to the banks. The banks turn around, sell them to a profit to the central bank. Once the central bank buys those Treasury bonds off of the banks, that is when currency comes into circulation. The banks then turn around and sell it to their bank friends. This is all government debt, by the way. These Treasury bonds is just government debt. The banks then sell the government debt to other banks. Once they've sold it to all their friends, we're then allowed to buy this government debt, and then it just goes into the secondary market and we just trade it. We just speculate on how likely we are going to be paid out this. This speculation, and all bondholders are in serious trouble now. They're at a big risk because the government may not. So Treasury bonds, they're basically assured by the government that the interest plus the actual debt will get paid off. Now it's looking like, whoosh, look at this stuff. It's looking pretty dreary. So the U.S. national debt explodes by over $500 billion in the last 3 months. The whole world is currently sitting on a $91 trillion debt problem. And here, like Forbes posted, that BlackRock reveals it's quietly preparing for 30, the old Irish is coming out, 35 trillion Federal Reserve dollar crisis. So 35 trillion is basically the entire debt that the US government holds, that the Federal Reserve holds, pardon me. So we have credit card spending, credit card debt at all-time highs, delinquency rates for credit cards, personal loans, mortgages, all rising, so more and more failures. World government debt increasing. World government debt means our debt, because when the government creates a treasury bond, like I mentioned before, it's guaranteed to get paid back. It's guaranteed that we have to pay it back. That's what the guarantee comes from. We are the ones being leveraged every time they create treasury bonds. Every time they want to spend some money, they create this treasury bond. We are the ones who, so just say when you take out a loan, you have a collateral and then someone, what's the word for it? Like the reference person that will guarantee the payment. The word escaped me now. Probably watching this knowing it. We are that person for all of the government's debt. So every time they do this, they're just fucking us more and more. Inflation is literally, so let's go back. The definition for inflation is wrong. Inflation isn't a rise in expenses, in the cost of goods. This is the byproduct of currency creation. So inflation is actually the creation of new currency. The reaction to that later is the price of goods acts as a sponge to new currency being created. So every time that there is more currency in circulation, that then flows into the price of stuff and then it rises. It's a byproduct of it. It isn't the cause. It's like, oh, we have lots of inflation. That just means they printed money some time back in the past. So we can actually see, look at this chart. This is really, really cool. So we can see this is the correlation of money supply and inflation. So we can see the direct link between the amount of money being created and inflation. Oh, the gentleman that created this chart, his name is escaping me now. I will link this video below. It's incredible. So he did a correlation for, anyways, it's a bit technical. Long story short, he figured out that 19 months was the sweet spot for where the last money printing. So in other terms, if you look back to the money printing of 19 months ago, so the M2, that's the monetary supply. If you look at the M2 from 19 months ago, that is the leading indicator to what inflation we're going to be experiencing right now. In those figures, if we look back 19 months ago, we have about 1 month left of inflation dropping and inflation is going to start rising again. So all of these charts tie into each other and it's super scary. So let's continue with the other metrics that are alarming. So the US national savings, pardon me. So this chart is depicting the amount of savings the American households have. It's only gone into negative 3 times. 2008, financial crisis, pandemic collapse, and we're currently in the negative now again. So it is a clear signal for it. This one's pretty scary. So the unemployment rate change. So this is a indicator for recessions. So if we look here, so what this chart is depicting, it's the rate of unemployment change relative to last year. So it uses the 3-month moving average. Every time this goes above 0.5%, 9 out of the last 9 times it has predicted the recession. 0 false signals. So literally every single time this chart has gone above 0.5%, we've had a recession. Look at here. We have just hit the 0.5% mark. No false signals. This one, another scary one. So this chart is depicting the 10-year Treasury bonds against the 2-year. Basically what it is, it's showing the rate of interest for long-term borrowing versus short-term borrowing. So if you take out a loan and you say you'll pay it back in 3 years, and your friend takes out a loan and he's going to pay it back in 3 months, he should get a much better interest rate because he's going to pay it back so much quicker. So this chart shows every time that short-term interest rates are more expensive than long-term interest rates. So it should always be cheaper to borrow short-term than long-term. This chart here, every time we get a blip below this line, this shows that short-term borrowing is actually more expensive than long-term borrowing. And if we notice here, after we get a blip down, the gray parts are recessions. So we blip down, and then as we rebound, as we reinvert, so as long-term borrowing fixes itself and becomes cheaper again, shortly after, recession follows. So we went down, short-term borrowing was just more expensive, and now long-term borrowing, we've reinverted, it's now more expensive again. So the correction has happened, which has one false signal. Where is it? Here. One false signal, I think it was in 1998, the only time this chart has incorrectly predicted a recession. And yeah, it's very strange to me that it's once things reinvert, that once we actually once the metrics are showing positive signs, it's when the recession hits. So this to me just screams that this is pre-decided. It's reactionary. It's not like this happens, we get the 0.5% or we reinvert here. These are just lagging indicators as to something that's already happened. It's cause and effect. It's all, everything started in 2008. Quantitative easing, it just changed the entire monetary system. The whole landscape completely changed. I haven't got a chart on here. I need to put this in the next one. It's fucking insane. It's it's depicting the, so if we had 10 people, it used to be that the 9 people would outweigh the 1. So I'm talking about like the richest in society. The amount that the 9 people deposited in the bank before 2008 outweighed the 1% or the 10% of the richest people. Since 2008, the whole thing completely inverts now, and it is just it's insane. Okay, so we have unemployment rate change, long-term versus short-term borrowing. This stuff is crazy as well. So we are in bubbles in most markets, almost every market now. This is comparing 2007 to 2024. So currently, before the first rate cut. So look, it's almost identical. July 17th top. It's just matrix shit. Like, how the fuck it's even the same day? First rate cut on September 18th, both times. So this is where we're at now. So price is about, oh, you can't see my finger. Price is, I wonder if you can see my mouse. We're about here now. So we're just approaching all-time highs again on the stock market. So look what happens after. We can see this big fall. So this is what I'm anticipating is going to happen. When? I don't know. US elections are coming up in a couple of weeks. Is it going to be before? Is it going to be after? I don't know what the game plan is. I don't know what or when, but it's coming. Like this, there's too much. This is like I mentioned in the last video, this is the house of cards. It's about to come fucking crumbling down. Yeah, this guy here, this chart, credit to Brett ETH. I recommend checking him out. Insane, just all of the correlations, all so similar. Housing is in uncharted territory now. So this chart is depicting the home price versus the household relative income. So even in the fucking crazy bubbles, it was only about 3-4 times. Now 8 times. So the average income, the household is 8 times that annual salary. So we're in the biggest housing bubble that we have ever seen. This is a crazy chart. So this is looking at the dot-com bubble when Cisco made up 5.5% of the US GDP. Nvidia, you all probably fucking know Nvidia, it makes up 11.7% of the US GDP. So 11.7% of all the fucking of the nation's GDP is in this stock. When the stock market tanks, this whole thing it's gonna come crumbling down. Yeah, it's fucking insane. So enough doom and gloom. There is a lot that we can do. So this is what I'm currently doing to hedge against this, to mitigate my risk. So it's an economic downturn, doesn't have to be down for us. Yes, it's going to be bad for the majority of people. However, there is a lot of people profiting from this, and you can be one of those people if you take the right measures. So first thing I'm doing is hedging against the dollar. So right now the dollar is pumping. I'll cover that in a second. But what we want to do is hedge against that. So hedge funds, the people who control the large amounts of money, it's in the name, hedge. So they're buying and selling at the same time. So they're covering their ass on the other side. So what we want to do is we want to hedge against the dollar. The most secure, always has been, hedge against the dollar is gold. This chart here, I'll get into it in a second. What I would recommend is silver. So this chart here, it's showing every time we have negative real rates. So the interest rates are decided by the federal government, the Fed, so the Federal Reserve, central banks. Real interest rates is when we get the interest rates and we minus the CPI. CPI is the inflation rate. That gives us the real rates. So when that is negative, when the interest rates minus inflation is negative, we have negative real rates. Every time we have negative real rates, as we can see from this chart, gold is bullish. Silver follows gold. Silver has much more room to climb than gold percentage-wise. So I recommend buying physical silver. It's the most secure thing I can see right now as to put your money into. The most secure. Physical silver. So just for some rough numbers, again, I'll try and link all the resources where I'm sourcing this information from. Most of these charts, by the way, are from the Fed, the actual federal website, the government website. But anyways, in terms of silver, there's an upwards projections of up to 2,800%. So the silver bullion is about $31 now. Based on the calculations, it is predicted that it can rise up to $900. So that's a 2,800% increase. Huge. Gold doesn't have half as much room to climb. Again, it's a sure hedge against the dollar, but I recommend silver. Anyways, moving on. So also trading these fundamentals. So this was when I put the chart together. This is the current position I was in. Economic turmoil. Whenever there's lots of stuff going on in the world, geopolitical issues, money flows out of risky assets, stocks, etc., into safer assets, aka the dollar. So anytime something negative happens in the world, geopolitically, the dollar is a safe haven. So what we're looking at here, the chart on the right, this is the DXY, the Dixie, the dollar index. Anytime there's geopolitical issues, as we can see this trend line here, this is when all of the stuff, the recent stuff, Israel, Iran, all broke out. So we can use this information to our advantage. So I use this to short the euro dollar. So this is the euro against the dollar. So we look at these charts here. This is euro on the left, dollar on the right. If you invert, so just flip it around, flip it upside down, the dollar chart, we can see how pretty much identical they are. So we can look to anytime something negative happens in the world, that's an inclination to sell the euro or buy the dollar. So this was trade you can check the date. I entered the trade on the 16th. It's now the 17th of October, selling the euro. If you don't know how to trade or want to trade, I do have a algorithm which I also use. So partnered up with another trader from the UK, and we have a algorithm. So you can check here. This is also the dates, current dates. It is a high frequency trading algorithm. So you deposit funds into it. I have a three-year track record on this algorithm. Last year it did over 100%. It averages 6% a month. So if you know about investing, you know that is fucking insane returns. All high frequency trading. Here's results. You can see it from today. So I don't know if you can see my laptop. Yeah, it's the 17th of October. You can see here all of these results. So balance withdrawal on today. If you want to get hooked up with this, drop me a message after this. I'll maybe put a link in there. Next thing to do, monitor the Fed. So we can come to the CME group, Forex Factory. What we want to do is look out for the Federal Reserve. So whenever they print money, this is when we want to invest in risky assets. So stocks, cryptos, etc. So we mentioned when something bad happens in the world, money flows out of these and it goes into the dollar. So when a new war is announced, put money in the dollar, buy dollars. When the Fed print money, put money into stocks, crypto, etc. It's literally X happens, Y is the result. It's cause and effect. What I was talking about earlier, that this inflation and these recession, etc., it's just a reaction to something. Everything is reactionary. When something happens, this is how they control the monetary policy. When the economy is booming and it's growing too quickly, what do they use? Interest rates and money supply. So when the economy is growing too much, the central banks will raise interest rates. This makes borrowing more expensive. So the more expensive borrowing is, the harder it is for you and me and businesses, everyone, to be able to access money. It makes money more expensive. So that is deflationary. That is bad for the economy, let's say bad. It slows economic growth, it reduces inflation, but it's good for the currency. So bad for the economy, good for the currency. When the economy is going bad, when we get unemployment rising, bad labor data, this means that the central banks have to intervene. So what do? They lower interest rates. They make money more accessible. They make money cheaper to access. They print money. This flows into the markets. So like we mentioned earlier, via the bonds, into the banks. From once it's in the broker houses, it then flows into the markets. So long story short, when the Fed is printing, put money into risky assets. When I say risky assets, I mean your favorite stocks, cryptos, etc. What we want to do is leverage, leverage, leverage. So whether you get leverage from the algorithm, this is an auto trader, by the way, all you do is deposit money and it trades for you. You have complete access to your capital. You can withdraw it at any point. You can do 5 withdrawals in a week if you want. Of course, the goal is to compound it, so you would keep adding to it. So then your 6% each month is getting bigger and bigger. So we just want to find that leverage, whether it's from the algorithm, whether it's from your own trading, leverage trading. We need leverage somewhere in our work, or in our income, let's say. We can apply it in our work. So my definition for leverage when it comes to work is achieving the most output for the least input possible. So going from one to one to one to many. So if you're a teacher, instead of teaching a classroom, you would teach online, so you can now reach more people. So whatever you're doing, just applying leverage to it in some way. So main tools for leverage: labor, so you can employ people to actually do work for you. That this increases your output. Product, it's going to be a digital product. You make it once, sell it an infinite number of times. Capital, this would be putting money into silver, putting money into algorithms to get traded for you. The internet, of course, reaching infinite numbers of people with just a video. Before we had to pay for advertisement, now we have free advertisement. Or a skill, something like coding, where you can write code once, again, sell it an infinite number of times. So important thing is we want leverage. I say want, I think we need leverage. The more these fuckers print, the less valuable each hour worked is. That means we have to change the way that we're working. We have to do something different because they're doing something different. 2008, it all started. That's when the fucking fuckery started. That's when they started printing crazy. Since 2008, 2020 was the next fuckery, when they just abused that power and just almost doubled the fucking dollars in circulation. And it's just gotten more and more crazy, and it's going to continue being crazy. I like this. Say money doesn't grow on trees. Trees can't grow fast enough for how much they're creating fucking money. This goes deeper. There's loads more shit to cover. I think that was enough for this video. This is coming to a head. This is coming. As I said, election time is coming up. It could be around then. Who knows when it is, but we have to prepare. We have to prepare. Send this to anyone you think needs to see it. This is important stuff. This really, really is. If you watch this, do not just scroll on to the next video. Actually stop and think about what you can do to protect your family, to protect those around you, to set yourself up to actually capitalize on this. I know it sounds horrible that so many people are going to lose their savings and their jobs and everything. That's inevitable. It's already done. As I said, it's pre-decided. They've already printed the money. They've already done that. So what we have to do now is position ourselves to capitalize on it. It's there. We can do it. as I said, buy silver. If you want to use this algorithm, hit me up. I'll leave a link below. But yeah, guys, I'll continue to dissect this stuff. But yeah, I'll catch you in the next one. Peace.